Peter Schiff, welcome.
Well, thanks for welcoming me to your channel.
Yeah. So you know a little bit about me. I'm 28 years old. When I was 19 years old, I was in economics class my freshman year of college. So this must have been right about 2009, 2010. And I raised my hand and I asked my economics professor why we could not audit the Federal Reserve and what we were going to do about the ever-increasing money supply. He told me to shut up and memorize the textbook. And then it became an argument in my class. No one in my class wanted to listen to anything I had to say. They just wanted to memorize the textbook. And so I realized shortly thereafter it was not a conducive place for my learning. I dropped out of school, and then I got into personal development space. I largely got into that because I was overwhelmed by anxiety and anger towards our economic system, and then fear, being younger and having a lifetime of inheriting these problems. And I give you a little bit of that backstory because I'm interested in your backstory as well. It seems like it would make a lot more sense if you were selling Roth IRAs and everything standard that, will get you pushed out at Barnes & Noble with your books, and it'll get you a regular show on Fox. What brought you to such a unique viewpoint that I would say it's becoming more mainstream right now given talks of recession, but what brought you to such a unique viewpoint and a unique place in the market world?
Well, first of all, I think what's unique about it is that it's correct. And the question is, why are so many people in my industry so wrong? It's basically for the same reason that your college professor was wrong when it comes to economics. I mean, the mainstream really doesn't understand economics, and the professors don't understand it. And, people in the financial community don't really understand it. All they care about is, what works. And so what works for your classmates was to just shut up and memorize the textbook because that's what they were tested on. And they weren't really there to learn. They just wanted to get a diploma because they think that diploma means that they're going to get a better job once they graduate. But, they don't really understand anything about economics. And the same thing with the investment advisors. They're just trying to do their job. They're just trying to not make any waves and do what everybody else is doing, do what's easiest. And that is to basically just rubber stamp these cookie cutter portfolios of U.S. stocks, U.S. bonds, no matter how overpriced U.S. stocks or bonds might be. And, to just ignore all the problems that underlie the U.S. economy, if they even understand those problems, because they believe the government, just like your fellow students believe their professors. People on Wall Street believe the government, they believe the economists, and they think everything is great. And they have no idea. I mean, just like in 2008, we had a financial crisis, and everybody on Wall Street and everybody in academia was surprised by the events. But I wasn't surprised by them. I had been warning about them for years. I specifically said exactly the problem that the Federal Reserve and government had created.
Explain this for people that are unaware of this. Please explain what the problem is that I maybe very elementary understood as an economics freshman and that you now speak so much of. Explain this problem because this is not something your average person is aware of.
Yeah, and plus, most people, whatever they know about economics, just intuitively, right, they end up forgetting or they don't just forget it, they get brainwashed out of it. So they lose all their common sense by the time they graduate with an economics degree. But people that don't have an economics degree maybe have an easier time understanding it. But the problems that we had prior to the '08 crisis, are the same problems we have now. And that's that the economy had evolved in a very unsustainable way because the Federal Reserve and government had intervened in the free market and had created outcomes that were not grounded in the fundamentals and were unsustainable. So what the Federal Reserve did is they kept interest rates artificially low. And so the interest rates that we have didn't adequately reflect the true supply of savings in the economy and demand for credit and time preference for money. We had rates that were artificially low. And as a result, we ended up with a shortage of savings and capital investment, and we had too much borrowing to finance speculation and consumption. Part of the speculation was in homes. Americans were levering up and buying real estate at overinflated prices. And the government was, of course, further enabling the speculation by guaranteeing the mortgages through Fannie and Freddie. And then Wall Street joined the party to securitize the mortgages through the subprime market. But again, the biggest driver of subprime was Fannie and Freddie, who were buying up all the subprime mortgages that Wall Street was creating and packaging. And so you had this crisis, this housing bubble that was wholly created by government policy, both in Congress and at the Fed. And I was warning about it for years and predicting a financial crisis once it popped, including the bankruptcy of Fannie and Freddie and what happened to the major banks. But of course, when we had that crisis, which was inevitable and easy to predict if you understood economics, instead of the government and the Fed learning from their mistakes, they doubled down on those mistakes. And now they have inflated a far bigger bubble.
Talk about the mistakes that they've continued to make, more specifically for someone who's unaware of it. You're talking about the quantitative easing, and what that really is the constant print of more and more money, which is only inflating the bubble rather than creating a solution. Is this what you're referring to, Peter?
Well, sure, but also just the reduction of interest rates.
Okay.
So when the Fed lowered interest rates to 1%, following the bursting of the dot-com bubble, which was also a byproduct of Fed policy, when that bubble popped, the Fed slashed interest rates not to 1%, but to 0. So they made an even bigger mistake than the one they made before. And they left interest rates at 0 for 6 or 7 years, far longer than they left them at 1%. And then when they started normalizing them, they only got to 2.25 before they just cut. And so they didn't even get back to normal. They took a lot longer to raise interest rates by a lot less. And so the problems that led to the financial crisis were the mistakes that were made while interest rates were too low under Greenspan. Well, interest rates were even lower for even longer under Bernanke, Yellen, and now Powell. So the mistakes that have been made in the economy since Greenspan are much greater than the ones that were made while he was still there. So the economy is in much worse shape now, right? Rather than putting out a fire, which the Fed is claiming credit for, they basically stoked a much larger fire that's about to erupt. And so the next recession is going to be far worse than the Great Recession of 08, 09. And the damage that is going to be done and the pain that will be felt by Americans will be far greater, because we're going to see not only a decline in asset prices and a recession, but we're going to see a big increase in consumer prices, something that didn't really happen during the last recession. So economists call this stagflation in the 1970s, when the economy is weak and prices are rising at the same time. This is going to be much worse because the economy is going to be much weaker than it was in the 1970s, but inflation is going to be much higher.
So stagflation means the economy is not moving, but of course there's standard inflation on the prices of things is what that means. So let me ask you, for your average, a lot of people that follow you are people that are intensely interested in these types of things. And I think that your work and other individuals in your space often gets overlooked, one, because of the fear of it, and two, you have to admit that everything you've been told about the economic system is wrong. Why is it right now so important that people take what you're saying seriously? You just alluded to your belief that you think that this crash is going to be worse than the Great Recession. Explain to me why this is important and how you really see that. Like, is it because, well, yeah, please go.
Well, there's really like two reasons. And, when I speak and I have my own, my podcast that I do, at Schiff Radio, and it's on YouTube. And
yeah, big fan of it.
Yeah, so there's two audiences that I'm speaking to, and of course they do overlap. But one is simply people who just want to understand the truth, and who I think it's important that they know the truth, because the public is being sold a bill of goods from politicians, particularly now with the rise and the popularity of socialism. They call it democratic socialism, as if somehow that makes it better. But it doesn't matter whether you have socialism by vote or by force, the end result is the same. But, a lot of people are seeing government through socialism as a panacea, as a solution to problems. that have actually been created by government. And so it's important because this is going to be a substantial economic downturn. I'm sure the media, the left, is going to try to blame it on Donald Trump.
Yeah, I was going to ask you about that.
Donald Trump didn't cause these problems.
Which is really important to distinguish. It's very important to distinguish because otherwise you're still, it's a Band-Aid. You're missing the point that there's an actual problem that's much greater than who's in office for a 4-year period, right? Because this has went on since Nixon suspended us from the gold standard and we started printing money, right?
I mean, for all the talk about Donald Trump, draining the swamp and make America great again, he didn't do any of that. Trump basically has continued the big government policies of his predecessors. The budget deficits are larger than ever. The trade deficits are larger than ever. There hasn't been any real substantive deregulation of the U.S. economy. There's been no cuts at all to government spending. Again, government spending has increased under Donald Trump. And so the only difference is the personality. Trump has a little bit of a different personality than Obama or Bush. And he's imposing some tariffs as opposed to other forms of taxes. But other than that, it's business as usual under Trump. But when the market collapses or the economy collapses on Trump's watch, the media and his political opponents on the left are going to spin it as if somehow the tax cuts or the deregulation are responsible, that somehow Trump inherited a great economy from Obama and squandered it the way he's squandered his inheritance from his father, which also isn't true. But the fact of the matter is, Trump did not inherit a healthy bubble.
And explain why, because your average person thinks that. And, you talk a lot about how really all it was they inflated all the asset prices from the housing to the stocks because of artificially low interest rates. It was easier to get loans and they were putting so much money in the economy. Is that an accurate summary of why it's looked appealing?
Yeah, well, first of all, Bush, 43, he inherited a bubble from Clinton. Greenspan inflated a bubble during the 1990s, and then Bush inherited that bubble economy from Clinton. It initially popped in 2001 when the NASDAQ bubble popped, but Greenspan was able to blow more air in the bubble. And so that bigger bubble, the housing bubble, didn't pop until 2008. But then Obama just inherited that deflating bubble from Bush, and the Fed was able to blow even more air into it with QE 1, 2, and 3 and 0% interest rates. But then Obama handed that bubble over to Trump. Now it's much bigger than the bubble he inherited, right? And now Trump has it. But the mistake that Trump made is once he inherited that bubble, he claimed it was a genuinely good economy and it was his fault. When he was a candidate, when he was running for office, he correctly pointed out that we had a big, fat, ugly bubble, that the Fed had artificially lowered interest rates to make the economy look better on the surface, but that it was a ticking time bomb, that we were headed for a crash, right? And he was right. Everything he was saying about the problems of the U.S. economy as a candidate were correct. The problem is, as soon as he became president, he acted as if all those problems had been solved and that he had solved them and that he had already made America great again. And now he pointed to the rising stock market as proof that he was a great president, when it was the same bubble that he criticized when it was happening on Obama's watch. So he owns this bubble now, unfortunately, and Trump is associated, wrongly though, with the free market, capitalism, less government. And so when this blows up, the public is going to blame capitalism, blame the markets from a crisis that was created by government, by the Federal Reserve and by Congress working together to inflate these bubbles and kick the can down the road to delay the pain from their fiscal excesses and regulatory excesses. And then, I think the public could go all in on socialism. So I want to make sure that there are people out there that understand the truth, that know that these problems have been created by government, and to not accept the false narrative that it's capitalism that is to blame. And that somehow if we had more government and less freedom, we would not have these problems, when the truth is the opposite. If we had more freedom and less government, if we had free markets and not central government planning, we would have a much healthier economy. Everybody would be prospering. And then number two, the other part of my audience is the investor, right? The guy or the gal who has savings, has investments, right? They've saved money and they're investing for the future, for retirement, or they're in retirement and they need their nest egg to, fund their expenses now that they're no longer working. It's very important that these individuals take actions to protect their wealth, right? I mean, if you don't have any wealth to protect, then it's no big deal. If you're a young person and you're spending everything that you earn, then you just need to understand the economics and you need to be concerned about your freedom and your ability to accumulate wealth in the future. But if you've already accumulated that wealth, if most of your working years are behind you, then you need to do something now to preserve your wealth. And you're not going to get the right advice from your typical financial advisor, financial planner, broker. You got to seek out, an alternative perspective like mine. And that's what I'm helping people do at Euro Pacific Capital, excuse me, is to basically restructure their portfolios to prepare for this, to understand that the dollar is going to lose a significant percentage of its purchasing power. And that means that people holding US dollar assets, stocks, bonds, real estate are going to see a tremendous decline in their future standard of living unless they act now to preserve that wealth by moving abroad, by investing outside the United States, by finding those countries that are not in as much economic trouble as we are, excuse me, the countries that have surpluses, not deficits, where the people save a lot, and they don't keep borrowing, where you don't have people relying on government-generated Ponzi schemes for their retirement, that they actually save for their retirement, so you have better macroeconomic fundamentals, sounder currencies, and you got to have a lot of gold and silver in your portfolio. You got to recognize that inflation is not just going to be confined to the U.S. It's going to be particularly bad here, but it's also going to be worldwide. And you need to have gold, you need to have silver, or other ways to protect your purchasing power from inflation.
So I moved into that second compartment pretty recently, and
congratulations.
Thank you very much. And I put a without talking numbers for the public, I put a lot into silver, and I bought all below 18. And so that's been interesting to see. And my question to that is, obviously there's people that are investing in gold, investing in silver. When you are doing in that, in that very small section of the overarching plan you have, one of those components is precious metals. One of the ways people get slapped, obviously, is they buy and then they don't sell at the right time, and then it goes back down to zero. Do you have, in a quick response, do you have any artificial numbers you're looking at specifically with silver that you think are an appropriate selling point, or no?
Well, first of all, gold and silver have never gone to zero. And so if you own gold or silver, the prices may decline, but they will never decline to zero because there's always going to be value to those metals. And so right now, I don't think people should be thinking about selling. Okay. I think they should be thinking about buying. I mean, there will be a point in the future. Hopefully.
I just bought like so much, and then I started getting anxiety because I was like, well, shit, what do I do now?
Well, if you bought so much that you're anxious, maybe you over invested in that particular sector. You don't
it's possible.
You don't want to lose sleep over your metals holdings. In fact, you should sleep better knowing you have some money in gold.
I'd say overall I do, but yeah, I was like, just, because some people, they get to the top and then obviously the markets are volatile and the inverse of the US dollar, and then they reinflate the dollar with a bunch more printing.
Yeah, I think we have a long way to go before we're nearing the top. I mean, we're still very close to the bottom in metals. But, what people have to understand and make sure when they're buying gold and silver, number one, don't get conned. You'll see advertisements on television, on some on talk shows, right wing, conservative talk shows. There's a lot of gold companies that advertise. You don't want to do business with any of those companies because in order to afford the cost of those ads, they have to overcharge you for your gold and silver. And often what that means is bait and switching you into these high markup so-called collectible coins, rare coins. It's all a bunch of BS, but they get you to pay 30, 40, 50% more for your gold than it's actually worth. So you want to go to a company like mine, which is Schiff Gold. We don't advertise anywhere because our margins are so small that if we advertise, we'd be out of business, right? So we only charge, 1 to 2% above our cost. and you're buying the price of gold very close to the actual price, the spot price. Whereas, on these so-called rare coins, you can be paying 50% more than the spot price, meaning the price of gold has to rise 50% just to get your money back, just to break even, which is ridiculous. So you should get some physical gold and silver, but go to my company, schiffgold.com, and we'll make sure you get the right gold and silver and at the right price.
Yeah, I appreciate you saying that. That is an important point. That was something that I learned a bit from Mike Maloney over there at goldsilver.com.
Yeah, he's a good guy too.
Seems like he's a good person.
And also, though, for people who want to be a little bit more aggressive, right, when it comes to gold, right, gold is about preserving the wealth that you have. But I think there's an opportunity right now to increase the wealth that you have by owning gold mining companies that mine gold.
I was just about to ask you that. So let's talk about that a little bit. You were saying a moment ago, though, which I wanted to bring up, but I didn't want to interrupt the flow of the conversation. You were saying that you think that when you have U.S. stocks, for instance, a lot of these gold companies, silver companies, and development companies and exploration companies are U.S. based. Does that hold the same risk that you alluded to briefly earlier? Like, let's say that whatever you bought, whether it was Kirkland, First Majestic, doesn't matter what you bought. You invested in Euro Pacific Gold Fund. Whatever you did, does that have the same risk because it's on the U.S. market? I've never went through a recession because I was a 19-year-old last time it happened.
Well, the political risk of the U.S. is generally, I believe, understated. I do think there is more risk in the U.S., especially if you look at, what the left is saying, the Elizabeth Warrens of this world.
Yeah.
They want to mandate that workers have a certain voting representation on the board of directors. They want to mandate that companies put the interests of their employees almost above the interest of their owners, their shareholders. You have a push for much higher corporate taxes. So all this represents political risk. Now, of course, there are a lot of other countries that have even more political risk where the governments are just seizing the mines. So I think on a scale, the risk in the U.S. is greater than what is generally perceived, but it's not as bad as some jurisdictions. But most of the jurisdictions, if you look at the gold companies, a lot of them are in Canada. A lot of them are in Australia, parts of South America. So you spread it around, but I think a lot of the stuff that we own is in lower risk jurisdictions. You mentioned my gold fund, the Euro Pacific Gold Fund, EPGFX is one of the symbols. There are various classes of that fund. My clients can buy it with their Euro Pacific account, but you can buy it at Schwab, you can buy it at Fidelity. I think if you're going to get into gold stocks, especially if you want to get into some of these smaller junior mining companies, exploration companies, don't try to pick these stocks yourself. It's very difficult. Let a professional do it. Get a diversified portfolio. Our portfolio, I think, is a great portfolio. It's managed by a guy, Adrian Day, who I hired to manage the fund because he has a lot more experience than I do.
David Morgan told me that he loved Adrian Day. I was just talking to David Morgan from the Morgan Report the other day, and he was saying that he's a great guy you got.
Yeah. I mean, even I know enough to know that I don't know enough about the junior mining sector to know, which ones to buy. So you want to get somebody that does nothing but analyze these stocks, been doing it for 30 or 40 years. So he's the guy to do it. In fact, if you look at our fund at the year end 2019, we had got 5 stars by Morningstar. Lipper had given me an award for the best performing gold fund over the past 5 years and over the past 3 years. So we've got a great portfolio. Of course, look, gold stocks are much riskier than physical gold, right? You can make a lot of money if gold goes up, but you can lose more money if gold goes down. So you got to appreciate the risk. You got to read the perspective. But if you are willing to take a risk, and I think that it's worth taking, you got to always weigh the downside, a risk versus the upside potential. And I think if you look at it that way, the potential for these gold stocks to go up, 5-fold, 10-fold, 20-fold, given where I think gold's going to go, is actually real. Now, you can't lose. I mean, worst case scenario, every company goes bankrupt and you lose your money. That's not going to happen. So the downside isn't 100%. But even if the downside is 50, 60, 70%, all right, well, if somebody throws in 10 grand, so they turn it into 3 grand. But if it goes up 10 times or 20 times, it's 100 grand, 200 grand. So if you look at what you potentially can make relative to what you might lose, I mean, I think it's worth the risk.
Yeah, if you're not in the space of just wanting to preserve your capital and you are willing to take a risk, which is an important thing, as you said, you made it very clear it's an important thing. So if you had one gold company or one gold stock that you were high on, what's one?
Well, again, I don't think you should put all your eggs in one basket. That's why I'm recommending the fund. So
that's why you do the fund.
Yeah,
okay, I
so
understand.
If you just have, somebody has the minimum, you can go directly to Euro Pacific Funds. If someone goes to EuroPacificFunds.com, they can buy my gold fund for just $2,500.
Cool. I'll do it, man. I'm less high on the market and more on preserving, but I'll go ahead and I'll do that, and I'm sure it'll go great. I wanted to ask you. I know you're a busy man yourself. How many minutes we got? I see you looking out of the corner over there.
No, I turned off. My phone was beeping, so I had to turn it off.
Okay, cool.
I'm picking my kids up from school, I think, at 3:15.
Okay, cool. So that's pretty soon here. So I wanted to talk to you a little bit about the housing market. First, I wanted to say, so my business started doing quite well a few years ago, and I got married recently, about that age where people say you should buy a house, right? So I live in Hawaii, and I live in Maui, and so I listened to an individual that he said, don't buy a house. And I said, this makes a lot of sense to me. So there was a house on the market here. I live in it now. And it was on the market for $2.3 million. Very nice house, 2.5 acres, got a guest house you can rent out as well. 4,000 square feet, ocean view. And they were trying to sell it. So it was going to cost me approximately, $450,000 down, and I could have bought it. And I ran the math, and it was going to come out to approximately $12,000 with principal and interest a month plus the $450 down. And in addition to that, about $2,000 a month in property taxes. So maybe looking at $12,000 to $14,000 a month for it. So I saw it was on the market for a while, and I contacted them and I negotiated to rent it to me for $6,500 as opposed to putting $450 down and $13,000 a month. And I get to keep all my money and buy gold and silver and invest in the market and be prepared.
And you know what? When the roof leaks, you just call the landlord. He's got to fix it. It's not up to you. Yeah. I bet that based on the house that you're describing, almost all the rent you're going to pay is going to go just to maintain the property. So all that money is going to be spent keeping the house you're living in nice. So you're getting all the benefits of the house, and the guy who's renting it to you is getting all the headaches and all the expenses. One of the big lies that you're told is that you should buy a house. And generally there are two people that will tell you that. One is a realtor, right? Because they want you to buy a house because they'll make a commission. But a lot of times people...
Does the other one start with a B?
The bankers?
Banker?
Yeah, well, they make money too on the mortgage, right? But I mean, obviously anybody associated with the selling and the lending process wants you to buy. But even a lot of other people who already own homes, psychologically they're invested in their home because they bought it because they think it's going to go up. And so they just always tell people prices are going to go up. But I just, on my podcast, my last one, I went over these houses.
Yeah, I wanted to talk about that because I saw that and I was laughing because I just did this whole analysis on my house, and then I saw you do that and I was like, hey, we got that in common. So explain that to me.
For most people, buying a house is the single worst financial decision that they can make. For a while, the realtors think, oh, it's a great thing because houses appreciate. No, they don't. I mean, actually, houses depreciate as they're worn out, as you use them, right? They think, and they.
So before you go on there, to the average person, so you may not see it that much, but the biggest people in the personal finance space on YouTube are a little bit older than me, around my age, and they made their money in real estate and putting $5 a day into their Roth IRAs. That's what they preach, right? And they would say, Peter, you're an idiot. It is appreciating. No. And my response to it would be, yeah, but the only reason it's appreciating is because interest rates are so low and they're printing so much money that the money has to go somewhere. So everyone's buying a home. Is that an accurate assessment? Because technically it is appreciating, although in Weston is
not all over the country. But look, we went through a big real estate bubble. And so people got conditioned to believe that that's the way it is, that real estate just goes up. Or, people will remember, hey, my grandparents bought this house in 1960s and they paid $5,000 and now it's a couple $100,000. But what they don't realize is A, the price of everything has gone up since then. There's been a lot of inflation, but it's not the same house, right? They've redone the kitchen, they've redone the bathrooms, they've replaced the roof, they've done all sorts. If they just bought it and didn't touch it, it would be a tear down, right? And you know, when people buy a tear down, that means the house is worthless. They tear it down to build up a new one. So that was a brand new house. All the tear downs used to be brand new houses, but they depreciated to nothing. Right now, the land maybe is more valuable, but that is a function of what's happened to the community surrounding it. Some land can become more valuable, other land can become less valuable. But people got conditioned during the bubble to think that housing prices just go up, that if you buy a house, it's just going to go up. It's not. And when I went over on my YouTube channel, it was in my town of Weston, and I just took one house, for example, and it sold brand new in 1996 for $2 million. 25 years ago. It's now on the market for $1.3 million. It's been on the market for 6 years, and the price has been cut. The guy first started at $3.5 million, and he's been lowering it. In 6 years, he can't sell it. Meanwhile, he's paying over $40,000 a year property taxes while he can't unload his house. And now he's down to, you know, $1.3 million, and there's still no buyers. So you're talking about massive losses over a 25-year period. I mean, what if he had invested that $2 million 25 years ago in something? I mean, where would it be? It'd be worth a lot more than $1.3 million now. And of course, he could have rented that house. I'm sure the rent on that house was maybe $4,000 or $5,000 a month. That was about equal to his property taxes. So
yeah, well, you look at mine's $6,500. My property taxes would have been $2,000. That's a third of it, and the mortgage would have been double what I pay for rent. Plus, it would have cost me $450,000 and insurance. Yeah,
insurance, maintenance, and again, I own property. Stuff goes wrong all the time. It's very expensive to maintain a property because of the elements, especially the house in Connecticut when you got the winters and you got the snow.
Here in Hawaii too.
Look. But here the hurricanes are coming. You know, what about, you know, my house in Puerto Rico got hit by Hurricane Maria, and I had like $300,000 of damage. I mean, I had some insurance, but it's still my deductible. I still had to come out of pocket $100,000. I mean, so these things happen over and over and over again. The air conditioners could break. You got to replace them. I mean, something happens with the plumbing. I mean, a lot of stuff. It costs a lot of money to own a house.
So one of my real good friends has about like maybe 15, 16 million in real estate. And that's what he's done. He rents it out, and he primarily owns in California and Florida. And I was just talking to him the other day, first time catching up in a while. And I was saying, hey, you ready for a dip in the market and we'll start buying? And he said, actually, I think it's going to keep going up with these low interest rates. And he was so excited about it. And I thought that was interesting because it's kind of the opposite viewpoint that I had. Would you please elaborate between my viewpoint versus his?
Interest rates are at record lows, right? And so they can't go much lower. I mean, we're basically, you know, practically at zero. But mortgage rates are historically low levels. So obviously the next big move in mortgage rates is up, not down, right? And I think it's going to be a resurgence of inflation that is going to drive rates higher. And the market is already weak now on life support. I mean, you have mortgages that are propping up the market, yet it's still weak. And so eventually when mortgage rates move higher, then there's nothing left propping up the market because real estate prices are still much too high for the average American to afford to buy a house. And of course, one of the only reasons that Americans can even borrow money to buy a house is because the government has guaranteed the mortgage through Fannie and Freddie. I mean, if the government wasn't—
Otherwise, you're saying the banks wouldn't even lend it unless the government was guaranteed.
No, they wouldn't take the risk because they know there's too big of a likelihood that the borrower is going to default. So it's only because the government is guaranteeing it. Like the same thing with the student loan problem. Why do you think students borrowed so much money? Because the government guaranteed it. The banks never would have made the loans without the government guarantees. And once the banks guaranteed the loans, the colleges kept jacking up tuition because they knew whatever they charged, the kids would get the money because the government was behind the loan. So they created that bubble in college tuition, the same type of bubble we have in the housing market. So ultimately, these artificial props are going to go away. And real estate in America is going to collapse all across the country because Americans are broke. They don't have any savings. They can't afford to overpay for houses. So the prices have to go. The government right now is trying to keep prices propped up by keeping interest rates low, but they can't suppress them forever. Rates are going to go up, and then real estate prices come crashing down. Then maybe there'll be an opportunity to buy some real estate as an investment. And I'm not saying that real estate can't be a good investment. If you buy rental properties, if you buy multifamily properties, and you can get a good cash flow on being a landlord, then that's fine. But what is not an investment is your principal residence. If you just buy a house and live in it, that's, it's like buying a car or buying a boat. Right? It's going to depreciate over time.
I rent every single thing I own, even my car. I don't own anything, even in this house. Everything in this house is rent too. And everyone thinks I'm an idiot. Everyone thinks I'm an idiot. My friend just bought a brand new truck, and then the first day he bought, no, not brand new, but it had like 30,000 miles. And he's so pumped. It cost him $22,000, and I leased mine for $300.
People were telling me that I was a fool for renting when I was renting back in the housing bubble days in California and then Connecticut. They said, well, you're throwing your money away on rent. And I said, no, I'm saving money on rent. You're throwing your money away.
And saving that principal, which is that if I would have bought that house and put $500K, I wouldn't have had all this money at this perfect time in this cycle.
Again, look at the guy that bought that house in 1996, paid $2 million, spent all this money on maintenance. I mean, if you look at the bathrooms and the kitchens, they're brand new. He's redone the place. Who knows how much money he's lost, a couple $1 million. He would have saved all that money had he rented. But he got suckered into the idea that, you're going to get rich buying a home. Now, look, there are certain advantages to owning a home, right? Then rent it. You could do what you want with it. You could decorate it the way you want. And so
I always think that one's stupid, though. I'm like, I'll put holes in my rental wall too. I'll just put something over it.
Yeah, I mean, but the thing is, realize that there's a cost to that, right? There's, you're buying the house for the convenience of owning it, but you're going to pay for that. If you want to forego those, you can save money by renting. But people think that renting is the non-economic choice. And especially now, because one of the reasons that people used to buy is because they got to write off the mortgage and they got to write off the property taxes. But based on the Tax Reform Act that we just had, under Trump, a lot of people can't deduct these costs anymore. And a lot of people are itemizing. They don't even deduct any of their property taxes or mortgage interest. So why are they owning? They should just rent, because the government's no longer subsidizing it at all. Other than subsidizing your mortgage, you're not getting a tax benefit from paying property taxes or mortgage interest. So just pay rent.
Yeah, that's definitely my view, and I thought that was really when I listened to the Hi-Ho Silver one from the other day, and you pulled it up. I'm like, I do this exact same thing. I've been trying to tell everyone. So, question: do you think it's possible that they're going to be able to keep this inflated forever? Which is what most people just assume without getting into the actual math behind it and really looking into the historical trends. They just think that it can go on forever, whether it's Mr. Bernie saying we'll just print more money, or whether it's just your average person that is dismissive of an interest level in a conversation like this, and they think, well, it'll just go forever. Is that possible that they can just keep printing it, and 70 years down the road prices will be higher, but we'll just keep increasing wages and it'll balance itself out?
No, that's what they say during every bubble. Trees don't grow to the sky, and nothing that can't go on forever will, right? They used to say that during the housing bubble, right? That real estate prices will never fall. Well, they fell, right? And so people think that we can keep borrowing money forever as a country, that there's no limit to the national debt. Hey, it's $22.5 trillion, no problems. It can be 30 trillion, it can be 40 trillion, it can be 50 trillion. There is a limit, right? You don't know how many straws the camel's back can take, but eventually you put on one too many and you break the back. And so we don't know where that limit is in the debt. And it's not just the funded debt, it's the unfunded liabilities, Social Security, Medicare, Obamacare, pensions. And it's not just the federal government, it's the state governments, it's the municipalities. Everybody is loaded up with debt, corporations, individual households, record high credit card debt, record high auto debt, record high student loans. And so you're building up this leveraged pyramid. It's going to collapse. I mean, we felt the beginning in 2008. That was just a warning shot at the beginning. But, they were able to, kick the can down the road for a while, and, we've run out of road, and now we're going to go for the rest of that crisis. We're going to finish what we started in 2008, and there's a lot more downside left. So as I said, people have to prepare for this, and it's much more important now than it was back then, because the Fed, if you got it wrong, if you were completely blindsided by 2008, as long as you did nothing, the Fed bailed you out. The stock market came back in many parts of the country. The real estate market came back, but you're not going to be so lucky the next time. The Fed is not going to be able to bail anybody out. They're going to try, but they're going to destroy the dollar in the process, which is going to create a much worse crisis, wipe out far more investors. So people need to do something now. Get some gold and silver, Schiff Gold. Call me up, talk to my reps at Europe Pacific Capital. Get your IRA, your pensions moved over to us so we can get your portfolios invested properly to withstand this. Because if you get it wrong, there's no way to repair the damage.
So one of the most popular types of channels right now in the personal finance space is, like, for instance, kind of like a millennial version of the Millionaire Next Door, basically. And it's essentially, put $5 a day, and in 78 million years, you're going to have $1 zillion. So that standard of the Roth IRA today, and all those types of things like that so many folks discuss online, some of the biggest channels. What do you think about that? And what do you think about people that say you're a moron for investing in gold and silver? There's no yield. Economies always go up and down.
Well, look, yes, there is no yield, but there's no yield just in putting dollars in a savings account either. And there's practically no yield in buying bonds. In fact, if you adjust bonds for inflation, the yields are already negative. So I would rather just own gold than a negative yielding bond issued by.
How about an index fund? That's what maybe somebody would argue back.
Well, because the index funds, the stocks in those indexes are overvalued. And the dividends that the stocks
and explain why that's overvalued. That's an important distinction, because someone's argument is, well, look how good the stocks are doing. Are they overvalued because of low interest rates and so much money put into the economy, and the money has to go somewhere? So it just keeps.
People are overpaying for stocks, but eventually the prices will come crashing down. And the fact that on paper they're going up for a while doesn't mean anything if you don't sell, and then the market collapses and you still have these stocks, and now they're worth a lot less than what you paid. But what I'm encouraging people to do with their money is not invest in overvalued U.S. stocks, but to find undervalued stocks, invest, in other countries that are not headed for the same type of economic crisis that we are, where you're not only going to end up getting higher dividends and better real returns on stocks, but you'll get the benefit of an appreciating currency that will help, restore what you lose as the U.S. dollar goes down. So I'm not against investing in the stock markets. I'm against overpaying for stocks. And I think people need to get out of harm's way. Just like real estate, look, you can buy a house if the price is right? Yeah. The house that you looked at that you're renting, if that house falls down to where you can buy it for $500,000, then maybe it'll be a good deal. If you can buy the house, in fact, already in Connecticut, the houses are selling for less than the cost to build them, assuming you got the land for free. So okay, we're getting near the point where there is value there.
Maybe they'll start giving us free land pretty soon.
But the problem
free land, build your house.
In the short run, if everybody wants to sell and there's no one that wants to buy, there's no floor. The prices can keep on falling. It's supply and demand. Now, in the long run, okay, no one's going to build houses in Connecticut because you can't make any money. So the supply will eventually come down, and maybe one day the demand will be there. But the prices could keep falling. And, real estate is very risky in that respect. You just can't sell real estate like a stock. It's not like there's a market and you can hit the bid. You got to put out a for sale sign and hope someone comes along and likes your house.
My neighbor's got a little bit nicer than mine, and their sign's just been sitting there for, 3-4 years. So here we go. In conclusion, you got to pick your kid up. What's a solution? You talk about, you believe that there's eventually going to be a gold-backed currency. I would like that, and it seems like it makes rational sense, even if the price of gold was revalued at $50 an ounce or something like that. But from the perspective of looking at the history of the elites and also people's lack of total understanding of why fiat currency is bad to begin with. To me, it seems like the actual, although it makes total sense, the actual possibility seems close to nothing. What do
Yeah.
you think about that statement I just made?
Well, first of all, people forget that up until 1971, all the currencies in the world were backed by gold. Either they were backed by the dollar, which was backed by gold, or you had the dollar, which was backed by gold. So in 1971, we ended a monetary system that began with the Constitution in 1789. I mean, we developed our whole country. America became the world's wealthiest country. We fought World War II, right, on a gold standard, right? So our money was gold, and the whole world was using gold. And even up until I think 1999 or 2000, Switzerland still had a legal gold backing to the franc. Now they don't have that anymore. So to have all these currencies, which we call fiat currencies, to have all these currencies not backed by anything real, this is not normal. And it has been tried in the past historically, but every time it's been tried, it's failed. And we always go back to gold. And this is the biggest experiment in paper money because every country is undertaking it at the same time. Normally, it's just a few countries that do something that's foolish, and then their citizens pay the price. But this time, it's the whole world. And everybody is going to suffer to a degree. Americans, I think, the most, because we benefited the most from this system because the dollar is the reserve currency. But when we have this crisis, people are going to go back to real money. Central banks are going to back their fiat with gold again, and we'll be back on a real monetary system, and the world will be much better off, and we'll have some more limits again.
Why would the central banks and countries want to ever do that? Especially,
well, they'll have no choice, right? They don't want to. But once confidence is lost in the system, the only way to restore confidence is to back the paper. If people start losing confidence and nobody wants to hold on to paper money, well, then they have to.
And then the government wouldn't just sit around and let you do that. They'd be like, "Oh, we have a solution. We're going to put it back," because they want to restore.
Yeah, like if you go to a lot of South American countries, let's say in Argentina, right, the peso is falling. How do they stop it? Oh, we're going to back it by the dollar. We're going to tie it to the dollar. They try to find some way to give confidence. But if people are losing confidence in the dollar, we can't tie it to the euro or the I mean, we got to tie it to gold.
Isn't that funny? It's like the U.S. dollar is printing. It's all backed by nothing. They're printing so much of it. Then all the other countries say, "Well, we'll back our currency by the dollar."
Yeah, so nobody's
like a house of cards
anything.
on a house of cards.
But you don't want to make the mistake of getting suckered into the cryptocurrency craze. There are a lot of people that say, "Oh, this means everyone's going to go to Bitcoin." No, they're not. Right? Bitcoin is also just a confidence game, just like anything else, except Bitcoin requires even more confidence because it's not legal tender, it's not used as a medium of exchange, and governments don't accept it in payment of taxes. So there's no demand at all. It's all speculators, and I think they're betting wrong. If you really want to bet against the central banks, then buy gold and silver. Don't fall into the trap of buying a Bitcoin. Now, yes, had you bought Bitcoin 10 years ago, you made a tremendous amount of money, right? But don't confuse brains for a bull market. People made money doing foolish things as long as other people did even more foolish things and paid even higher prices. That's the greater fool theory. So if you buy into Bitcoin now, all you're doing is helping somebody who got in a long time ago get out. So they're making money at your expense because what they made is going to equal what you lose.
So you're kind of like a Jim Morrison dressed up in the financial world, the renegade of it. So in conclusion here, let's recap for someone who may be new to this type of information. Super quick recap. You can just tell me if I'm right or wrong. So the reason that the Fed is dangerous and the reason that paper money is dangerous is because if you keep printing more and more and more of it, then the purchasing power of the dollar goes down and down and down. Just like if you have too much of anything, it loses its value. The problem with that is our whole global economy is set up off of United States dollars, which is actually going like this, going like this, going like this, and then all the assets from stock market, real estate, it needs somewhere for all this paper to go, so it keeps popping all these things back up.
The big problem with paper money is it enables big government and reckless government. That's why governments don't like it. It lets governments just, play Santa Claus and pretend they can give us something for nothing. Under a gold standard, if the government wants to spend money, they need gold. And so that's hard to come by. But under the current standard, all they have to do is create it out of thin air. And for a while, people think all the government paid for by a printing press doesn't have a cost because they don't see their taxes going up, but they see their benefits going up, right? Trump, they just had big tax cuts, but they also increased government spending. So we got all this government for nothing. Well, we didn't get it for nothing. There's a big cost. It's actually more expensive to get it for nothing than to pay for it with taxes. So, we have had this huge run up in government and debt. We've lost all of our freedoms. Gold is the defender of freedom, right? That even Alan Greenspan wrote an article before he was on the Federal Reserve, Gold and Economic Freedom. I suggest people take a look at it.
I'll link it here. I heard about it from you and I read it and I was like, what in the hell? This is the guy that's supposed to be the head of the Fed saying the only real money is gold and silver.
Yes. Well, and he still believes that to this day, because Ron Paul says he ran into him in the hall one time and asked him if he still stood behind that article. And he said, yes, he wouldn't change a word. And he probably feels more confident now, given that he knows what a disaster is waiting. He wrote the playbook that these idiots are following, except they don't realize how the story ends. Greenspan knows, because he knows a lot more about economics than the people that followed him. But, so when we go back to the gold standard, it's going to be a step in the right direction. People think, we're going backwards. We're not going backwards. We're going forwards, because the gold standard was an improvement on what preceded it. And what people want now, this fiat standard is a disaster. It's never worked in the past, and it hasn't been working now. That's why the standard of living of middle-class people has been going down. That's why you have this huge disparity now between the very rich and everybody else. It's all about the monetary system. It's like blood in your body. If your blood is bad, your body's not going to function properly. Well, money is the economic blood of the body of the economy. And it doesn't work when it's just fiat money. Money needs to be a real thing. It needs to have real value. It needs to be a commodity, right? When you're exchanging money for something, you need to be exchanging something of value for something else of value. Right now, we exchange nothing for something, and it doesn't work.